It's Kelly Buckley again, and we appear to be frozen. Here we go. Good morning, everybody. It's Kelly Buckley. Sorry we're starting a few minutes late. Been a little bit of a busy morning. It is the 5th of June, or is it the 6th? It's June 5th of 2020, sorry. And today we're going to be talking about something I think could have some import to a lot of you. Haley and Eric and Jacob and I have been kicking around some ideas concerning maybe occasionally doing a Facebook Live that pertains to actual questions we're getting from different clients via email, text, and phone calls. So that's what we're going to do today. And what sparked that discussion is this slide. Why are the equity markets up over 42% since March of this year, March 23rd actually. As clients, you're probably aware that on April 2nd, we did declare that March 23rd was likely to be the market low, and we strongly advised each of you to invest at that point if you were saving any money on the sidelines. So this slide kind of goes through some of that guidance. You see on number 1, April 2nd, our recommendation and our impression that the market had hit a low point. On April 9th, we pointed out that the financial damage during the decline literally was done in a 2 to 3 week period. That's one of the reasons it was very difficult for us to rationalize leaving the market, because we knew it was likely to be very short and sharp on the downside and equally sharp on the upside. Note under number 2, I stated it is our belief that over the next 6 to 9 months, our economy will have completely recovered the ground it lost over the last month and a half and will move strongly beyond the old equity market highs. Then on April 16th, we had a posting stating we anticipate that today, when the Trump administration reveals its initial plans for reopening the economy, that the market should respond in a positive manner. And as you know now, we were off to the races. June 5th, March 24th, 2020 through 9:30 a.m. when the market opened today, our average client account has appreciated 58.05% net of all costs. This chart corresponds to what we just showed you with the date of our market low call on April 2nd. We called March 23rd as the low, and then the other correspondences leading to today, and a total of 58.05% return. So the question that we have received pertaining to why are the markets up so much, this is the interesting one, and can that possibly continue, I think is best shown on this depiction. You know, there's this famous saying, and I believe Benjamin Graham said it first back in the early 1900s, that the markets climb a wall of worry. And guys, all that means is in life, there's always something wrong. There's always something that's going to concern us. I admit they seem to have stacked up in 2020 to a pretty phenomenal extent, but there's always something going wrong. And despite that, the market's long-term performance clearly shows that the market does climb this wall of worry. So let's go to our next slide, and let's talk about an example of this that I think many of you may resonate with because it's very recent. You all remember probably back in 2018, particularly the fourth quarter of 2018, we began to see dramatic market declines. And this is beginning in October, right here on the chart, of 2018. Those declines were driven primarily by pundits, economists, market analysts, etc., deciding that the yield curve in our nation's bond system was inverting, meaning that short-term rates were higher than long-term rates. That's called yield curve inversion. That led to a steady decline throughout the quarter, and then a very steep decline in the month of December that approximated 15 to 20%. And that produced much correspondence between us and you pertaining to those issues, because the pundits, once they decided yield curve inversion was occurring, also decided recessions would immediately result. If you go back and look at our correspondence during this quarter, you'll note we said no yield curve inversion occurs until the 2-year and 10-year yields invert, and pundits had a yield curve inversion between the 2 and 5-year, so it was meaningless. Didn't fit the definition, in other words. I also pointed out that on average, from actual yield curve inversion, which never occurred, that the equity markets rose for 13 months. And I won't go into all the reasons why, but believe me, from an adjunct professor's standpoint, that'd be me, that's common knowledge. And it's in every finance and investment text. So we argued against that flawed view, and that produced an amazing return in our clients' portfolios that began when we called the market low on December 24th of 2018, and gave us a return that was about 10 percentage points above the equity market returns that we showed depicted here for 2019. So can it continue? This is important. And hang on just one second. I'm looking at something here that just came in. I'll come back to that. Mm-hmm. Did you just get that one?
Yep.
Okay.
Amen.
All right. Just got a question. I'm going to come back to it. So I guess the crux of question one that I need to answer first is, can this market movement continue? Our firm, net of all costs, has investor accounts now up over 50% from the market low of March 23rd that we called on April 2nd. The answer is unequivocally yes, it can. The reason it can applies to this next slide that you see behind me. I hope you guys can read that. You know, I've talked about the tsunami of stimulus that's affecting this market. I talked about it prior to the market's movements, and I predicted the most epic, mind-boggling recovery in the history of our country. And I'm talking about a recovery that's both economic, meaning adding our jobs back, and that's investment driven, meaning your portfolio's movements. Those relate to all the factors you see here, and there's a synergy that goes on between those factors. They're not just happening at one point in time, they're acting together over a long period of time. Probably the most important one is the over $8 trillion in stimulus spending between Federal Reserve Bank actions and the fiscal side. That's money authorized by Congress. Folks, that's at least 3.5 times as much stimulus as we've ever applied to any serious recession or the Great Depression or any economic problem our country's run into, wars, etc. It is literally and virtually a tsunami of stimulus. When you toss that much liquidity into the markets, two things are going to inevitably result throughout economic history. One is equities, stocks, are going to go up a lot. The other one is bond yields will eventually rise, because when you add that much liquidity, you've got a lot of cash running around chasing a certain number of goods and services, and that causes prices to go up, which means higher inflation. Higher inflation means lower bond prices. So for those who are sitting on bonds, you've had a great run, and that payday is likely over for a very, very long period of time. Interest rates, when they start moving in one direction or the other, tend to go up for 20 to 30 years or down for 20 to 30 years. Or we're coming off zero interest rates again, and we're likely to see a sustained upside. I have to also mention our second point, a potential fifth wave of stimulus. Looks like we're going to get another stimulus program, and our firm's viewed as absolutely unnecessary, and it should not occur. It'll give us even more inducement of inflation 3 or 4 years from now. But it's likely to occur, and it may represent what you see as the fourth bullet point, and that's a possible infrastructure spending project that on both sides of the aisle in D.C., both Republicans and Democrats, they want to see an infrastructure program because our nation's roads and bridges and dams are not in the best shape. The point above that is also crucial to the continuance of this and a reason why it must continue. Trade, in our view, I got to say that. Trade deals, USMCA, the Mexican, Canada, and America trade deal that passed at the end of last year, and China Phase 1, which China has affirmed through their trade minister, they are going to stick by the terms of that deal, kick in full force this month. Those deals have effects that will reverberate for, I believe, decades, but certainly many, many years. Next, reemergence of American manufacturing dominance. You know, in the 70s and even into the 80s, America was the dominant manufacturer of virtually all goods. And then with the passage of some very, very flawed trade bills, we gave away that dominance. It was a conscious decision. It resulted in literally millions of manufacturing jobs being shipped away from our country to other countries, primarily in Asia, Indonesia, China, other countries, South Korea, that in some cases didn't have the friendliest of relations with us. But they took jobs that were high benefit, high pay for folks with high school educations, and they shipped them and they replaced them due to NAFTA, trade agreement passed in 1994 under President Clinton's administration, that were service related, not manufacturing, low pay, tending towards minimum wage, and generally zero benefits. So we're now seeing those jobs come back. The issues with China relating to what led to Phase 1 of the trade deal, which was stopping intellectual theft, and that is actually built into the deal, stopping forced technology transfer on the part of American corporations doing business in China, where they had to give them technology or they couldn't operate there. All these things are going to lead to jobs coming back when you combine them with COVID-19 and Chinese threats to stop supplying pharmaceuticals manufactured in China to U.S. customers. So it's my belief, and this is an opinion, that we're going to see hundreds of companies bringing factories back with tens of thousands and probably hundreds of thousands of jobs in the next 2 to 3 years. Next, national security policy changes. The president's executive orders recently cracking down on Antifa, a thuggish outfit that targets the weakest among us, puts them at the front of peaceful protests, and then attacks, shoots, stabs, and runs over our nation's police forces in the most cowardly way. Those changes are going to cause Antifa to lose funding quickly because Mr. Soros and others who give to them, it's now a federal crime to give to them. They've been designated officially by the president's executive order as a domestic terrorist organization. Contributions to them, whether it's in kind or in cash, are a federal crime. You're going to see those folks dry up and go away because if George Soros and his minions are not paying them to show up and foment violence in those protests, they'll find better things to do, like watching Netflix at home on their mom's couch. Those national security changes and the things that were done in the China trade agreement are going to result in the continuation of our nation's above average economic growth. Pent-up demand. This is a big thing to me. I know many of you, because I've talked to many of you, have really enjoyed getting back and being able to take your family out to a dinner. And most people, I think, are doing that more than they normally would to make up for lost time. They're also doing that in vacations. Vegas is open for business. They're doing that with the airlines. Delta is a great airline and business for Delta, American, United, and across the board is up significantly. Why? because once again, the pundits were wrong, and we called this too. People are not going to be scared to get back on the airlines. They'll do it with a mask on. Airlines are going to require that, and they should, because we're kind of in a closed container and we can't maintain social distancing, at least for a while. But you're seeing the airlines move in a very, very strong fashion over the last month or two, and that's driven by this pent-up demand, by the fact that load factors on those airlines are coming back at a much faster rate. We thought they would. That's why we bought Delta in April. That's why we bought Marriott, because people want to travel again. That's why we bought new acquisitions in the banking sector, like Capital One. But pretty much everything else in our country, in the investment sense and in terms of the economy growing faster than expected, are going to come back at a rate that's much higher than was normally expected. The last point is a major one that's going to drive this economy very strongly. And I'm going to go ahead and give you an opinion here that I kept to myself until mid-September of 2016. And that's when I called the last election. And I said the president would trump and it wouldn't be a small margin. And from an electoral college standpoint, it was a large margin. All the polls had the opposite result, just like they do today. And I won't go into all the reasons, but I've studied statistics at the master's level and the undergrad level, and statistics are going to lie to you every time when the questions are framed in certain manners and when the proper statistical modeling and testing is not done. I've looked at the electoral college count. I think the margin this time is going to be much, much larger. And I don't want to sound political, but I definitely want the re-election of President Trump's policies that have done so much more than any of his predecessors, except maybe President Reagan in our lifetime, to bring our country into a new golden age, to get sentencing reform so minorities are not treated differently, to reform our prison system and not incarcerate people who never deserved incarceration. They deserve punishment, but not scarlet letters that lasted the rest of their lives. To get minority employment across the board, all minorities, down to record levels. That's what really lifts people up, not handouts, not what the founder of the Black Entertainment Network, BET, called for earlier this week, which was, I believe, $16 trillion of reparations to minorities, to our black minorities. I've got a lot of African American friends. I had the privilege of playing football with them at Bryan Station and winning the state track championship in '75 with them. And they don't want that. Not the ones I know and talk to. People don't want handouts. They want hands up. They want a level playing field. And I think what we need to do with our president is watch what he does, not what he says. Because what he does is pretty amazing. It's already turned this economy around. Those policies will remain in place for the next 4.5 years. There's very little chance, in my opinion, that will not occur.
Kelly, we had a question come in regarding the trade deals. Do you think that will the COVID-19 coming from China make the trade deal not go as smoothly?
So COVID-19, thank you, Haley. COVID-19 coming in can impact the trade deal. But you may have noted last week, China's trade minister spoke to that in a public news conference and said that they fully intended to abide by that trade deal. One of the things I've noticed, and this applies to Antifa, it applies to thugs on the street who are not Antifa or just trying to rob you, is that bullies, when they get punched in the nose, always run. The previous administration, and maybe his predecessors, were scared of China. China pontificated a lot, postured a lot, and threatened a lot. And the threat of war is a very serious threat. But America's military power, its chain of command, are stronger than that of any two of our adversaries together. Probably three. And so China, I believe strongly, will maintain the trade deals and move into phase 2 quickly. China's going to lose a lot of business because of the actions they took during COVID-19. And if they truly want to isolate and destroy their economy, which would lead to a regime change, I believe, in their government, then they would trash that trade deal. They would stop talking to the EU, the European Union, about revising the trade deal they have there, which is going to happen too, I believe. So the answer to that question is, I do not believe it will affect the trade deal with China. I think strongly that if it did, it would hurt the Chinese, 3 or 4 times more than it would hurt our economy. It would also speed up our self-development so that we're producing more in our country and taking even more business from China. So I don't think there's a snowball's chance in Hades that that's going to happen. Next question that we have gotten a lot of is, what is making my specific investments rise more than the S&P? So let's look at that in this slide. You might note that from our March 23rd market low call, our client accounts, as of right now, this is within the last hour or so, are up a net of 58.05%, just as we expected. And then that begs the question, because we're beating the indices by a little over 16 percentage points right now, why? Why are our accounts up more? Well, there's a lot of reasons why. One, we fell more than the market during the decline. And then during the bottom of the market in early April, we reoriented our portfolios because it was our firm belief that the economy would come back at a rate significantly exceeding the expected rate. So we acquired things like Marriott, like Delta, that had, like DBO, the oil ETF, when oil prices were in the toilet. We acquired things that we believed met our firm's criteria for purchase, and that is significantly low relative valuations and the ability to significantly exceed the market in the near term, intermediate term, and long term in terms of price performance. So that's what's really driven Spectrum investment models versus the S&P, versus the market. Next question. Why doesn't SFA invest in more technology companies, or what are called FANG stocks? And this question, folks, has really come to me a lot in the last year. I've heard this from quite a few folks. Most of you are aware, I think, that one of our largest holdings is Qualcomm. QCOM is their symbol. And Qualcomm is the leader in ownership of proprietary, that means patented, 5G technology. 5G is known as the Internet of Things, where we're gaining control over things that are around us, like our light switches, locks on our doors, coffee makers, using the internet. So we do have a significant technology component in the portfolio. But the FANG stocks come up a lot because they make up a huge part of our economy. Facebook, Alphabet, Netflix, Google, FANG. Why don't we own them? You know, we have owned Facebook in the past. Why don't we own them now? That's a good one to talk about. Facebook has significant regulatory issues. They're getting a lot of government heat. And when industries get government heat, eventually bad things are going to happen. Maybe they get regulated. Maybe laws are passed that significantly and directly impact their business practices. This is why Facebook's profitability has gone down so much over the last 2 quarters, because they've had to bring in literally tens of thousands of employees to monitor their own site. Their site was being used by ISIS, by Al-Qaeda, by Antifa, and still is in some cases. So they had to police themselves more. The feds started to look at them. that's going to significantly impact their profitability and reduce it, in my opinion, more in the future. Netflix, Alphabet, Google. You know, when I think about the FANG stocks as a whole, I think about years in the past, like December of 1999. In December of 1999, I sold all the technology stocks that our clients owned. And then I was pretty heavy in mutual funds, so if they were techie kind of funds, I sold them. If they were Microsoft or Dell or other type of tech companies, I sold them. Why? Why did I sell them? Because if you look back at the 3 previous years, they had gone up 300%. So a lot of clients ask, Kelly, why are you selling this stuff? And the reason I was selling it was because their valuations were 3 to 4 times the S&P 500 or the Dow Jones index, and their relative valuations compared to their own historic norms were also 3 to 4 times higher. And I just couldn't see paying $130 for $1 of Microsoft's earnings when the market was paying $20 for $1 of other companies' earnings. And I felt like they had gone up a lot in a short period of time and it couldn't last. So I sold on December 1st of 1999. And I got a little bit of heat for that sale because until early March, they kept going up, early March of 2000. And then began a decline that lasted over the course of a couple of years in the NASDAQ index, what was then a pure technology index, of 71.81% in those same technology companies that we're looking at right now. And now, when we look at technology as a whole, especially the FANG stocks that everybody's piled into because their brother told them to, they are very overvalued. And if we don't see value in the initial purchase price, meaning the ability to buy something at a level that fundamentally is less than their intrinsic value, then we don't want to own them. So I hope that answers the question for all those who are listening on the FANG stock issue. Next question is, how large does an account need to be? Now, we've gotten this from folks calling us because they were going to refer their kids or their grandkids or friends, and they didn't know how much money they had. And, you know, we used to have minimums. Our minimums until the end of 2018 were $500,000. And we would waive them if clients requested us to for referrals. But that was where we wanted to advertise we started. And folks, in our business, at our level of assets managed, and at my level in terms of time in the industry, that was a very, very low number. And, you know, I was open to a lot of criticism from my peers who said, Kelly, why aren't you at least at $1 million? And I'm going to tell you why. We changed our minimums to $0 in December of 18. And I guess the reason was, you know, I got to be a grandfather for a few years by that time. And I did not believe that it was helping people who needed the help to keep high minimums that you raise to 7 figures or even 8 figures simply for your own financial benefit. I'm also a lifelong Kentuckian. And, you know, Kentucky on the asset scale is really low. So when you look around our community, if we want to do something good for the community and we want to add value, then we should help those who need help. And many of them are kids coming out of college or kids coming out of high school going into the workforce who have $2,000 or $10,000 or, you know, $50,000 to invest. Or maybe they've got $100 a month to invest, but they want to accomplish something and no one is going to help them. And that got me to thinking about my mom. When my mom passed away in 1990, she had an IRA that had grown from $2,000 to $5,000, and that's what she died with, and that's all she had. And I got to tell you, that was critical money to her. And so any account that's referred to us is going to get great treatment and great handling. And our minimums are zero because we want to help the community. And we especially want to help those who need that hand up and aren't looking for a handout. That's really important. So our minimums are zero. Next question is, and this has come up a lot, what can I do better now to ensure my financial future? And, you know, I got to admit, to me, at my point in the industry, a lot of things are kind of intuitive. We do a lot of analysis, a lot of numbers crunching. And I'm a student of economic history. And those two things guide me. But I also note in myself that some things are intuitive to me. So when you look at the market now, it's intuitive to me, and this is an opinion, that we're at the initial stages of a large-scale economic advance. And that economic advance is going to be epic. We've seen these huge returns since the March 23rd low. And in investor minds, many folks are thinking, well, gosh, I'm too late. We're not too late by a long shot, given the factors I've already covered that are going to continue to drive this economy, especially the tsunami of $8 trillion in stimulus. So we're not only not done, we're just starting. This thing is going to, 5 years from now, when we look back, we're going to be looking at an economy that did things that absolutely no one expected, that grew at rates that were well above 3. Probably within the next 4.5 years, we're going to see a year that's 5 or 6%. 5 times what we're told by the previous administration to expect forever. Because remember, China was going to dominate and exceed our economy's size by 2019. And it didn't. They're about a third smaller. And that's relying on their numbers. And it's because we changed policies. So if you want to ensure a better financial future, invest in stocks, get out of bonds, increase your savings rate, put yourself in a budget if you find yourself without cash to invest at the end of the month. And remember the 10% rule. Save 10% of your gross income. If you're working, do it in your pension plan or in a deductible manner so that you get that extra tax benefit, and especially so that you get any employer match that may occur or a profit sharing contribution that may occur. In most pension plans, they don't have to give you the profit sharing contribution if you're not contributing to the 401k. So that's an important point. So I think, and I'm a little out of order here, hang on just one second. I want to use the housing market example you see here on this slide. I want to talk about that a little bit. People are going to naturally think, wow, if equities, stocks have gone up so much, the market has done so well, it can't continue. And we saw the fear that was induced in December of 2018, which we fought against successfully with all but I think 1 or 2 of our clients who did take us to cash. It's their money. They can do that. I want to point out the housing market example. If you look at Phoenix, Arizona in 2007, the end of the year, median house prices were $336,701. And then you go 4 years forward, and it had fallen by more than half to 157. And you all remember that was the housing crisis and financial crisis of 08 to 09 that produced that result. But you didn't see panic selling in Arizona. People didn't realize their houses had declined by 53.23%. The reason they didn't realize is the statement isn't staring them in the face that month. And almost unfortunately, yours do. And this is why sometimes if you want to better your financial future, understand we're looking at the intermediate term and the long term. And we're going to look at it appropriately. We've been doing it at a high standard for a long time. That's not going to change. But we're not going to worry about the speed bumps in the road. And believe me, next year, when people look back at COVID-19, in our opinion, they're going to look back at it and they're going to say, that was a speed bump. That was what Kelly Buckley called the glitch. And he said he doesn't sell in glitch events. Folks, when we liquidate your capital and we go to cash or other instruments, we do that in recessions, just like we did in 2008. But we don't do that in glitch events because you never know when the glitch is going to end. You never know when new information is going to come out. So don't look at your statements so much when we're in a bad time. It induces fear and it induces panic. And when you're in that fight or flight mode, you're generally going to choose to fly, to run. And in a glitch event, that's the wrong thing to do. I think another thing you can do that would help someone else's financial future is look at the fact that our clients have tended long-term to have double-digit returns. And returns that, according to Delbar, here's a slide on Delbar, have been about twice the average investment client, because we approximate long-term the S&P 500's returns. Why do we do that? And why for 25 years, when Delbar has measured investor returns, had they found that standardly investors get half the market's return? It's because of that fight or flight impulse, and because they don't have professionals providing them information that helps them understand the market's movements, and also being able to delineate through that professional what is a flight event, truly, like a recession, and what's a glitch event, like the rumor of yield curve inversion in 2018 or COVID-19 in 2020. Very important. So save, look at your spending, cut back on things that are unnecessary, particularly in a bad market, a glitch event. Have faith. Have faith in economic history. And, through our economic history, 100% of the time, our markets have recovered. Even in serious recessions like the 2008 to 9 recession, or the Great Depression, 29 to 39. Markets recover. Our economy recovers. I have faith in my beliefs. I have faith in our knowledge of the markets, and I have faith that we're going to shepherd you through those things. Let me see. What else do we have, Haley, on questions?
We have our next slide, and then we have 2 questions
Okay.
that go along with that slide.
We'll go to that next slide then. This was asked actually yesterday by a good client, and I'm not trying to be political. That'll get me in trouble, folks, because I do have some precious and dear clients who don't see the political spectrum the way I personally might or other people might, and their opinions are valuable to us. But this is an important question, so I'm going to address it. There's been so much going on, and our president has been criticized for certain statements he's made during the pandemic and the riots. You can call them protests, but there's infiltrators in those peaceful protests that have turned them violent. And I'll call that a riot when you burn things down that other people have built with the expense of their blood, sweat, and their tears. But I think it gets back to what I said earlier. Look at what our president in this administration does, not necessarily what they say. President Trump's actions during the pandemic are masterful. It was a lesson in leadership in terms of organization, bringing all the federal elements together and the federal powers together to produce the amount of PPE that was produced, to stop foreign actors like China from grabbing all the PPE worldwide, and then developing therapies and treatments, as well as a big jump start on a vaccine. I think it was masterful, and I believe his decision early on to stop travel from China, and then basically everywhere, especially the EU and Asia, was brilliant. He was criticized from the right and the left, but particularly the left. He was called xenophobic, racist, bigoted, and that action literally saved what is likely to be millions of lives. He also began during April, I'm going to say mid-April, to question our public health experts, which was also equally masterful. When you're in the public health profession, your job is to save lives. And in their view, they're covered by the Hippocratic Oath. One life, I think they'd say, is enough to shut down our economy. But the law of unintended consequences is realized, I think, to a greater extent by our political class maybe than our medical class in many cases. And I don't want to destroy our children's education, destroy the life's work of our citizens, put people at home and pay them twice as much as they earned previously to stay there on an inflated unemployment system, and skew the dynamic to bigger and bigger government, more government control, less freedom, less independence, less individual initiative. That's what the president's policies started to realize in the mid-April time point, when he realized that if he allowed the medical professionals to run everything, we'd be shut down through the end of the year. Thank God we're not. Thank God we have states that showed leadership and courage, like Georgia and South Carolina, to open early, Florida to open early and first. And you're not seeing huge upticks, you're seeing some increases in some of those localities, but nothing approaching an emergency situation from their hospitals. So we may have some more folks get sick. We now know who's vulnerable. We know that 70% approximately of the deaths are with people who are 70 and up. That's a vulnerable population. We've learned you shouldn't quarantine healthy people. In the state of Kentucky, we've learned that virtually no child that below age 19 has died. And so there's no reason to keep our kids locked up and out of school, Governor Beshear. So let's learn the lessons and let's apply them. So I'm very admirable of President Trump's handling of that.
Kelly, you have 3 questions that go along with that.
Yeah, let me get one more.
Okay.
As far as his re-election, my opinion is you got to look at the Electoral College first and the Electoral College rules, and that's unfortunate for some on the left who really believe in socialist policies, who have pushed their to-be nominee to that level. It's not going to happen. President Trump's victory this time is likely to be much larger. That means his policies are going to be reelected. Yeah, Haley.
So our first question is, at what point does the market turn its attention to the election, or has it already?
Yeah, I think that's a really good question too. I don't think the market has looked at the election much. But if it has, it would negatively weight it, which means maybe we would have gone up 70% instead of 58% in our client accounts. The market generally, get to around the July, August period. That's where we start to see much more recognition from the market and analysts that the outcome is going to affect us economically and in an investment sense. I was asked this question during Senator Clinton's run. What happens if we're wrong, and what happens if, in this case, likely nominee being Joe Biden, what happens if he's elected? I'm going to give you the same answer I gave then. Little or nothing will change. You know how I know that? Because President Clinton and Senator Hillary Clinton were bought and paid for to a greater extent by the financial services industry, that's my industry, and the banking industry and the insurance industry, than any 2 candidates in political history. They received more money from those lobbyists than anybody did. They were bought and paid for. So they would have run to destroying certain companies that are unpopular, etc., but they would have never opposed them in office. They existed to gain power. I think the same thing will happen here with former Vice President Biden, in that his policies will deviate from what he's bowing to the far left now and promising. Next.
Our next question, we know how unreliable polls can be, but will these polls showing Biden with a large lead have a negative impact on the market?
No, I think one thing that we've learned in the last 10 years at least, maybe 15, is that polls don't tell us much of anything. I think the market is an incredibly accurate predictor of the future. And in fact, if you look at the leading index of economic indicators, folks, which is reported by the Federal Reserve Bureau of Labor Statistics, it consists of 30 components, and it's intended to predict future economic activity, and of course that directly affects the investment market. If you look at the component that is most inherently accurate in the leading index, guess which one it is? The market, the S&P 500. So the S&P is looking ahead 6 months to 9 months. So right now the S&P is already looking at or past the election. That's an interesting point, isn't it? But individual investors and our attitudes, they don't tend to be shaped until we get into that summer and late summer time period. Anything else, Haley?
We had one question. You kind of touched on it a little bit. Will the stock market correct if Biden wins, and would we change our investment strategies at our firm if he did win?
And so I kind of touched on that a little bit. I would mute some things that we've positioned now if Biden did win, or I felt he would, but I wouldn't do a lot because Biden is bought and paid for by big money corporations in the U.S. Chamber of Commerce, all of which I decry. Duty on our country is what I've based my life on, and I believe in individual freedoms, and I believe in every precept that was in preamble to our Constitution and our Bill of Rights, and I'll support them. Is that it?
That's it. That's all
Okay.
our questions.
In closing, this has probably gone a little longer than I should have. I want to speak to the riots specifically. I want to talk about policing in America because I think it's important. You can turn me off if you want to. This has nothing to do with your investments. I have long thought that our police force needed some retraining. And I'm going to tell you that I also have more respect for policemen than anyone in our country except the United States military. It's tough to be on the front lines, and I could not do their job. I wouldn't have the patience that they have, and I'd probably get in more trouble than some of them have because of that. I admire each and every man and woman that puts that uniform on, and I recognize that they do something that very few of us ever do in our lifetimes, and that is they know walking out the door that they might not come back. But training of our police force for a long time has been a problem. Back during Columbine, you might remember in 1999, I contacted our chief of police and the head of internal affairs, and they didn't have a plan to go into the school if the sound of gunshots was occurring. They informed me they do the same thing that Columbine's police force did, the local town there. They'd hug the wheel well while kids are being shot and killed. So we had to talk about that, and they changed their procedures at our local emergency response. And that was good. They allowed history to rechange their training or retrench their training. We need to retrain police officers. There's some police officers that are bad apples, and they're not a large percentage of the force. But there is a significant percentage of our police forces that do not turn in the officers who abuse the citizenry that pays them. And I can speak to that personally because as a United States Air Force officer and fighter pilot, I can assure you that one of the requirements of my job as a flight lead, as an instructor pilot, as a evaluator pilot, as a flight commander, was to take care of the bad apples. And sometimes they didn't get more than one bite at the apple. Sometimes they didn't even get a warning. They just didn't get to fly anymore. Their careers were ripped from them. So why on earth our police forces protect themselves this way, I don't understand. I think it destroys the profession of policing, and it's got to change. But I want to say this clearly. I know a lot of black and white officers, and I don't know a single one of them that's racist. And so I believe that Black Lives Matter and other organizations have misidentified the problem. I don't think the problem is racism, except in isolated incidents, which is why we have hate crime laws. I think the problem is training across the board, and I think I've had significant knowledge of incidents and been involved in one or two myself where I knew the police officers involved were doing the wrong thing. And I was white. And some people, I guess, in our communities would say because of that, I was privileged. But I wasn't raised in privilege. I was raised in dire circumstances. I don't believe white privilege exists, and I don't believe that police officers are racist in any sense of the word. So please think about this. Write to your congressman, your senator, our president. Express your views, and it may differ from my own. But if you're a police officer, I'd ask you to please examine not only your training policies, but how you control your own force. It's not about covering for each other. It's about weeding out bad apples. And with that, I wish you and your families a wonderful weekend. Thank you so much for your business. We appreciate you all.